loan officers? Do you want all of your favorite loan officer podcasts on one page? Well, the marketing animals, they have it for you. From lead generation to team building to marketing ideas. Go listen today. It is all free. The only thing you have to do is click this banner right over there. Hey guys, Brian Stevens here with the National Real Estate Post. I have Dave Stevens on today to discuss something that just came down a couple of days ago. And I think that there could be some pretty big implications to mortgage companies for what's taking place here. There's some things here that I don't think I've ever seen before. And maybe, Dave, you can shed some light on this. So what we essentially have is we have an arrangement, an agreement. It's called a Memorandum of Understanding between HUD and the FHFA, which is the GSEs, which says that they're going to share information on enforcement actions with fair housing, that if anyone opens a case, they're going to notify the other one. Has this ever happened in the past where HUD and the GSEs are working together on issues like this with fair housing?
Well, it's funny. I think back to the NBA, and they, to this day, they still, would hope that the FHA HUD and the FHFA would work more in sync together. So, for example, Brian, the proposed capital policy that Ginnie Mae put out, on their own, no consultation with the FHFA or the GSEs in terms of what capital rule policy they may be working on, totally not in sync, right? We've talked about it in servicing standards, the national, the servicing policy that, not the servicing policy, excuse me, the defect policy that the GSEs put in place, which allowed you to fix errors and things of that sort. And they were hoping HUD would do the same in order to limit the risk of false claims violations for minor errors. On servicing, how to handle loss mitigation and the waterfall, they're different between the two companies, two organizations. So here they're finally sharing information and working together. And I actually got an email from an Inside the Beltway guy yesterday, joking with me about what I had written in Housing Wire. He goes, "Whoa, two regulators actually working together. That's a shock." But what's interesting about this one is that the MOU, and MOUs are common between agencies. I actually was part of an MOU with the Department of Energy once upon a time when I was at HUD, unrelated to this. But so MOUs happen. Not completely unheard of. Between FHFA and HUD, it is much more rare because FHFA really sort of regulates private companies, Fannie and Freddie, semi-private. They're in conservatorship, but nevertheless, usually a little less subject to the political whipsawing effect of regimes that come and go in office. And so, this is the interesting one where they're going to share information. The most important thing everybody should take away from the MOU, and you should read it, but the MOU says that they're going to share even, and the word contemplated is used several times in the MOU, contemplated examinations, enforcement actions, and other actions that they're going to be potentially taking with a lender. But the important part here is even contemplated fair housing examinations. So these are cases where the originator will have no idea they're even on a list, that something's being contemplated.
Wow.
They may or may not have violated any fair housing rule. That's why it's only in contemplation right now, right? You would assume. But nevertheless, the MOU says that HUD will inform the FHFA or vice versa. So imagine, someone in the Fair Housing Enforcement Office at HUD, which has nothing to do with the FHA. It's a separate assistant secretary that runs the FAO office. And they're contemplating an action, an enforcement examination of you as a lender. And whether you've done anything right or wrong, let's assume you haven't for a second. They notify the FHFA. I think the FHFA then has a fiduciary obligation to notify the GSEs and say, hey, just got notified. HUD's looking into XYZ lender. I need you guys to do the same. So suddenly you're getting a call from your Freddie or Fannie person saying, hey, we need to send a team in to look at you for this, even though they weren't even thinking of an examination in the first place. It certainly raises the bar of risk. Not that you're going to get accused of anything, but at minimum, you're going to spend a lot of money digging up files and looking at data and having to meet with regulators simply because one shared with the other the fact that they're contemplating an examination, investigation. It does include enforcement actions, but all of this is interesting in the MOU.
Let me ask you this. You wrote in your article, you said the mandate states that it is not enough to simply have policies in place that intend to block any discrimination, but policies must also ensure that the effect does not create an adverse fair housing outcome. And this is the affirmatively furthering fair housing. So what I'm hearing from you is that if they're contemplating things, it's not just good enough that you have policies in place that would ensure that your company is not discriminating, but you have to almost proactively go out to ensure equal outcome. If you'll just entertain me for a second here, you give 3 examples of affirmatively furthering fair housing. The first one that you wrote is determine who lacks access to opportunity and address any inequity among protected class groups. 2, promote integration and reduce segregation. And 3, transform racially or ethnically concentrated areas of poverty into areas of opportunity. Is it really the role of a lender right now to address such lofty expectations that are so outside of lending's purview to where they have to go into areas of poverty and turn them into areas of opportunity? I'm not saying it's not a great thing, but is that necessarily the role of a mortgage lender?
Well, look, those aren't my words. Those 3 sentences I took from the affirmatively furthering fair housing policy implementation announcement that came out from the White House. So those are the objectives of the AFFH rule, which are in place. Keep in mind, HUD has single family lenders, multifamily lenders, they have hospitals, they have a whole healthcare group. And so there are a lot of ways you improve communities, and there are multiple assistant secretaries at HUD, right? There's an assistant secretary that just does things like CDB, community block development grants, and Section 8 housing and things of this sort. So it's not just the FHA program that comes under the auspices of the HUD, of the Secretary Fudge at HUD. So yes, these are a bit of lofty goals, but the rule is very clear that, the line is that it doesn't always matter whether you intend not to discriminate. The measurement will be, is the effect discriminatory or a fair lending concern? And so I'll give you just a simple example. The FHA program allows for, I got to introduce you to a new member of my team. That's Charlie.
Oh, I like Charlie.
You guys have met Chloe before. Chloe didn't make it after age 13, but Charlie is new to the gang.
There you
go. So let's go through a simple case. FHA allows credit scores down to 580 with a 3% down payment, right? That's part of their standard underwriting policy.
Right.
You and I both know that most lenders, some do, but most originators don't allow 580s at minimum down payment, especially larger banks, et cetera, that have already put overlays in place in the program. So that's just part of reality in the program today. The challenge is that originators set that FICO minimum at all sorts of different areas. You may have some investors that will take 620, some might take 600 with some compensating factors, some may have a 640 minimum. It just depends who they are. The question is, even though you're trying to originate to the standards set by your investors, is the effect discriminatory as a result because you're not providing the opportunity to use the full credit box? And even more importantly, are the investors you sell your loans to suddenly subject to an AFFH violation because their credit box, because they believe default rates are higher when you get below 640, and it's intolerable for them to deal with False Claims Act risk and other sorts of potential risk downstream to the servicing portfolio. So they put a 640 minimum where someone else is at 620. We all know, well, if you don't know, I will tell you, in the delta between 640 and a minimum FICO of 600, you have a lot of minority borrowers. You have a lot of folks who are considered protected classes. And I'm not certain what the case will be. There's a business risk defense that has been used in the past to allow for judgment to be used in the FHA program. But in the case of this new MOU, could the Fair Housing Enforcement Office decide that they're contemplating an examination of XYZ lender because they're noticing that they have a much higher credit bar than others in a particular market, and they've received a complaint from someone in Houston or wherever they operate, and so they're contemplating examination. They notify FHFA as part of their normal course of communication per the MOU that they're contemplating an examination, and what happens out of that? And does the FHFA then immediately report to the GSEs? To the GSEs and have an obligation then to look into it themselves? And suddenly, whether guilty or innocent, are you dragged into at least a lot of work to defend your case? So yeah, it's tough. Now I'm going to give you a defense of the AFFH rule for a second because it's important. We have an industry that we could today far less, but historically, particularly in the FHA program, there's been huge examples of discrimination in the mortgage banking industry and in real estate and home building. I mean, when soldiers came back from World War II in Levittown in New York, which was a huge mass development to build entry-level homes for returning soldiers, you can pull it up on the internet and look at ads for Levittown. It says no, whites only was the sign. So, I understand the fierce effort to try to expand the homeownership opportunity to those that have been disenfranchised out of the housing system for decades. And even today, the homeownership rate gap is huge. So I'm not arguing against the need to have a focus on fair lending in America and in our system. I will say that the GSEs are now going to be, because of this MOU, and it expires in 2025 if you read the MOU, assuming it doesn't get extended, they are going to be wrapped into a little bit of the political leanings of whoever is in the leadership at HUD at any given point in time, right? I mean, President Trump and Secretary Carson eliminated the AFFH rule. President Trump trumpeted it all over the media and talked about you'll be safe in your neighborhoods or whatever antics went on at the time politically. And then, this administration has re-implemented the AFFH and now doubled down with an MOU. By tying the GSEs into this sort of world, at minimum, even reporting that someone's contemplated an action, that even if the FHA commissioner isn't aware of it, it could be out of the Fair Housing Enforcement Office that's contemplating the action. I think it does expose our industry. I think this is let's hope it's not a big deal, but it certainly leaves the opportunity for with all this information exchange, even when there's no evidence of violation or wrongdoing, that something could create an action by the other investors, whether it's FHA and HUD or whether it's the GSEs and FHFA, by reporting to each other, contemplated. I'm going to share with you one more story and I'll shut up. I ran the single family business at Freddie Mac for almost a decade. And back in the day, we had an information sharing process where not all the time, most of the time, we would report to our other GSE if there was an action we were going to take on one of our seller services. So if there was something that they had really violated, we didn't want adverse selection to take place and have the other GSE stuck holding the bag on someone who was doing something really bad.
Sure.
And so we would report that, but that was after evidence had been accumulated. We were ready to take action. We were terminating them from the program from being an approved seller servicer to Freddie or Fannie. To Freddie Mac at the time. We would report to the other and vice versa. That I could understand. The contemplated word being used in this MOU is indicative to me, at least, if I interpret it based on the English language. It says there doesn't necessarily have to be evidence or proof or fault here. It could be simply the contemplation of an examination or an action or an investigation. But these are things that I just found interesting in an MOU between two agencies of the federal government that rarely, if ever, cooperate on anything and work together. And here's the one thing they picked to decide to work together on, which is great. Fair lending is an important issue, but I think the way this is written and the fact that this is the only thing they've cooperated on, frankly, and worked together on with consistent policies, is really interesting, to put it mildly.
The FHFA, they put out a statement. It said the agencies anticipate that the MOU will lead to stronger oversight that will help advance vigorous fair housing enforcement that can begin to redress, an interesting word, redress our nation's history of discriminatory housing practices. It almost feels like, the statement almost feels like we're going to make up for lost time. Are you concerned that they might be overstepping their boundaries? You've said the term contemplating a number of times now, and that does seem kind of problematic. Is this just putting the industry on notice that they are going to come out there and they are going to find fair housing violations come hell or high water?
Well, let me suggest this, and I don't know if they'll find violations, but I do believe that there is a concerted effort in this administration, and with efforts that are going on Capitol Hill in Congress, to proactively, or affirmatively is another way of describing this, promote home ownership and housing opportunities, particularly for those that have traditionally been disenfranchised, specifically minorities. And let me just give you two scenarios. Congresswoman Maxine Waters, has a down payment assistance bill that's been introduced in the House Financial Services Committee. She's chair of the committee, and the bill would provide down payment assistance for first-time home buyers and first intergenerationally to have owned a home, meaning their parents or their grandparents could not have been homeowners before. That is clearly a bill targeted towards minorities. And there's no denying it. And frankly, I applaud that effort to try to figure out how do we bridge the gap for folks that where the single biggest barrier to homeownership is down payment. And they don't have intergenerational wealth. There isn't as much intergenerational wealth for African Americans as there is amongst whites. That's proven through Department of Labor's savings statistics studies that are publicly available. So I applaud that, but it certainly highlights again a real effort, a deliberate effort to promote and focus on improving access to homeownership for minorities in a nation where, after decades through Republican and Democratic administrations of talking about improving homeownership outcomes for minorities, the African American homeownership rate today is about the same as it was 40 years ago. Yeah. So but there is focus there. So that's an area that I think that is one consideration as you think about why this rule was the one thing they decided, this MOU was the one thing they decided to focus on. And then two, I would say, is the independent mortgage banker. The phenomenon, and it's not really a phenomenon, we can all explain it, but the fact that mortgages are now 2/3 or more of mortgages being done, and 3/4 of mortgages being done in the FHA program are done by non-banks, is one that's creating a lot of interest, right? We have states talking about, some states, 3 in particular, are talking about passing legislation that would put CRA-like requirements, Community Reinvestment Act-like requirements on non-banks, because non-banks aren't obligated to any standard. Banks are, at least through CRA. People can argue whether CRA is good or bad. I'm not going to do that right now, but at least banks have to make sure that they're reinvesting when they take in deposits as entities, and that forces them to look at census tracts and maps and underserved areas where they have branches and make sure that they're doing mortgages there. So that doesn't exist in the non-bank system. And so think about it. The non-bank system today is held, other than they can't discriminate. They are covered legally by anti-discrimination laws, but they are not covered by any proactive obligation to go out and do affordable lending. If you go to Wells Fargo or Bank of America, they have whole teams that are in the mortgage division that do nothing but focus on affordable lending and lending to minorities, improving outcomes. And they spend millions and millions of dollars focused with manpower, personnel on that outcome. You generally don't see that in the non-bank sector. We have non-banks that are really good at doing minority to diverse populations. New American Funding, Patty Arviello. She's first generation. Her parents are came to the states from Mexico. I believe it was her parents or her grandma. But she has built a company with a lot of Latino presence, and they do a good job serving the Latino community, particularly the Hispanic community in the markets where they serve. And you can see those select pockets of institutions that do that. But we have a lot of originators, as you well know, we're really good companies, really well managed. They're disciplined, they have integrity at the CEO level, but it isn't necessarily something that they have dedicated headcount to focus on expanding diverse opportunity within their organizations. They may talk about it, they may attend meetings, but they don't have necessarily the infrastructure like a lot of other companies do. I think an MOU like this is the beginning of like shots over the bow. That Maxine Waters bill, people beginning to talk about CRA obligations on non-banks, which we've heard both from some federal regulators suggesting this, as well as some states talking about it. It should be a bit of a wake-up call. And if I could just add, in the independent mortgage banker business and in general, people used to tell me when I was head of the MBA, they'd say, I'm so small, I'm below the radar, I'm not worried about CFPB or whoever it is. The IMB sector is no longer below the radar, right? They're so huge that as a sector, it's become a policy area of focus for folks in housing. And we've got folks in the White House from Bharat and Erica, and these are folks. Bharat worked for Elizabeth Warren. Erica Pothig works in the National Economic Council. She worked at HUD with me. We got folks placed around this administration that are more progressive and very concerned about outcomes here. And I do think a policy like this is a wake-up call. And I think it should be a particular wake-up call to the larger IMBs in the marketplace, that you really need to start thinking about what you do proactively, to put it another way, affirmatively, to further fair housing. And I think if you make that an effort, that'll be a start.
It's interesting because you brought up Maxine Waters' bill. That is very much a carrot approach to addressing the inequities in housing. It feels like this MOU is much more of a switch approach, to carrot and switch. And I'm just wondering if these policies are best achieved at the end of a switch. One thing that you brought up, and I want to ask you about this one as well, because I'm thinking affirmatively is a word that you continue to use as well. When you look at, and with the MOU, it's kind of created this whole secular model where HUD could start something and it can end up in the lap with the GSEs. But with the GSEs, you have LTV and credit score, loan level price adjustments out there. So you can make an argument, because we know statistically speaking that African Americans and Hispanics have lower credit scores and are generally going to have higher LTVs in underserved communities. This is creating a disparity in terms of the rates that lenders are going to offer, not because of what they're doing, but because of the adjustments that are in place. So again, this is hypothetically, HUD, who seems to be a little bit more aggressive in enforcement, starts to look at a lender who is serving two fundamentally different communities, finding a disparity between these rates, which is kind of it's institutionalized. It's part of who the GSEs are. HUD opens this up, the MOU puts this back in the lap of the GSEs, and I find something very ironic about that a lender could find themselves in harm's way over something that is a policy from the very group who's going to be enforcing actions against them.
Yeah. Well, it's a good point. But the FHA is what is flat pricing, right? The better credits subsidize the worse credits, and the GSEs have a risk-based pricing model. And we all know that the trade away with a low down payment, 5% or less down payment, or 3% down payment, that around a 720 FICO score, you actually probably get as good or better rate going through FHA. And there's a reason why 2/3 of all African Americans got their home loan through the FHA last year. And you see that in the HMDA data. 80% of FHA's total purchase population are first-time home buyers. And the majority of both Hispanics and African Americans get their mortgages through the FHA. And I'm not going to go, there's a whole reason why this is the case because of, and FICO has a lot to do with it, but it does cause a challenge. However, I think both regulators, I would assume, will look at the overall production from an originator, right? If you're an originator and you can sell to Freddie, Fannie, and you can sell the FHA, VA, USDA, and some private investors, it's going to come down to how does your distribution for the state, the markets where you operate, compare to your peers, both depository and non-depository. And if you're an outlier, if you're way inside in terms of better credits and much wider than your peer group and you operate in the same markets, I would say you have some exposure at that point, at least something to explain. But I don't think it's going to mean that, I think it comes from the reality of recognizing that the GSE's risk-based pricing structure is going to work better for some borrowers than others, where the FHA is the same price no matter who gets into the program. And there's going to be, depending on where you sit in the FICO, LTV, DTI structure, you may only have one choice, or you actually may have a better rate by going one way or the other. So all that's part of that kind of environment.
So in conclusion on this, for lenders right now, there's really no actionable items. Look at their policies and procedures right now and try to assume that to look into things that are going to be affirmatively furthering fair housing. Are these things that they need to be looking at right now?
Yeah, I mean, I think yes is the easy answer. I don't expect everybody to run out and hire a dedicated resource to focus on expanding their advancement of lending opportunities to bring in a more diversified borrower population. However, if you're big and you can determine whether you come under that scope of being under the radar or in the radar vision, I think you should be considering two things. On a defensive basis, I think you need to have very strong organizational mandates that any counteroffer, not just let alone decline, but even a counteroffer on a refi and purchase to a protected class needs a second level review. And it needs to be reviewed for appraisal discrimination and any other adverse outcome that could be considered a fair lending violation. So you just have to give those loans a second level review to make sure that you're making the right decision. I think counteroffers are equally as risky as declines in that regard. So that's a defensive measure that I think most people have in place. I don't know if they do it both on refis and purchases, but I would be doing it across the board on all my mortgage population. I know it's a little more expensive, but I would require second level review. On the proactive side, the question is getting to, at minimum, if you don't want to hire the resource, your management team should be having some form of regular, steady meeting and planning process to strategize how you expand your borrower pool to be able to bring in more attributes that would be considered affordable lending attributes. And I'll give you just a simple case. I have one of my clients talk to me the other day and said, man, we don't like DPA. It's just too difficult to deal with, down payment assistance. Maybe we need to go back into that and think about it more broadly and make sure we have DPA programs in all the markets we're serving, particularly the markets that are that have more diverse populations, and really promote those things. So, even in the end of the day, I think if you can show you're showing marketing activities that are proving that you're trying to expand your sphere, your market area boundaries to move into communities that could be under focus in an effort like this, I think you'll be at least in a safer place.
Yeah, it's interesting when you brought this up. Is what I immediately thought of. I've had more than one conversation with IMBs where they run away from down payment assistance programs and they run away from bond loans, and they're very vocal about it. We don't want to do these things. We want to stay in this box here because these are safer and they're more profitable.
Well, the bond loans are smaller, and with the points and fees cap, it makes it difficult under an LO comp rule to pay your LO anything. It's hard to do them and make money. At some point you've got to consider, is subsidizing certain products better than being in an investigation? And that's a question everybody has to make. But look, I think this isn't going away. I think this whole debate over with non-banks playing such a large role, you got to remember CRA was put in place. The Community Reinvestment Act was established before the non-bank system had anywhere was even, may not have even existed, I don't think, in any real way when CRA was first put into place, because banks were taking in deposits from communities of color, but they weren't lending there. They didn't have outward bound efforts to try to generate loan volume from those markets. It was really targeted towards our industry primarily, which is mortgages and home ownership. That's what's created the CRA rule. There is no standard today for non-banks, and everybody's beginning to talk about it. It's bubbling up, not everybody, it's bubbling up in a whole lot of areas. And it's something that could be looked at under the purview of the CSBS, the Council of State Bank Supervisors. The CFPB has pledged to focus on fair lending. You now have Sandra at the FHFA, who has signed this MOU with Secretary Fudge. And you've got other folks like Elizabeth Warren and Maxine Waters talking about that on Capitol Hill. I don't care your politics. This is about being prudent in terms of how you run your businesses. And I think it's worth having executive team meetings and talk about, are you doing enough? And that's probably a good place to start.
Well, we'll see what happens in the future, because I agree with you. I don't think this is going away. It struck me as kind of a shot across the bow as well, coming out with this MOU. And after reading your article, which, by the way, I'll attach that down below, what Dave Stevens wrote on this. It's just really precise and to the point. It outlines exactly what we're talking about very clearly. So that article will be down below. I encourage everybody to check it out. So we'll see in the coming months what happens. But Dave, thank you once again so much for your time, and congratulations on Charlie.
Thanks, man. Take care.
Thank you. Have a good day.